And that's tough. That's tough. That's an art, I think, rather than a science. And you've got to look at where they've been, how long they've been with the company, what are the moves that they've made. Is the company in the shape it's in because of moves that they've made? You can get situations where there's a lot of heavy inside ownership, and that's where all the control is, and there may be very, very, very little hope there for that company. You got to look at turnover. What have they done before? Are they sucking this thing dry? Because you can see situations where management compensation is just excessive, and you're never going to see any money out of the name. But that's a very, very tough one, because there's no real numbers there. You can look at compensation. You can look at compensation, relative to someone's bottom line. An example there, and this is not a net, but it's a company, a very, very well-known company, especially if you were a kid in the 70s, 80s, and even now, Tootsie Roll Industries, which I'm sure you're familiar with. Not a net, mid-cap company that's been around for a long, long time, and it used to be a great little company, net margins in 14, 15, 16% range. Maker of Tootsie Roll and Tootsie Pop and Charleston Chews and all these great candies that we had as kids. So it's a company I owned for a while, because I very much believed that, rock solid balance sheet, lots of cash, no debt, paid a nice dividend, looked real good, and it looked to me for a long time like somebody, like a Hershey's or a Wrigley, would take them out. It was a great, perfect acquisition for somebody. So you bought and you waited and you collected your dividend, and what you started to notice was margins are declining every year. Revenue is staying the same every year, or just going up a little bit. There's no new products coming out. I mean, Tootsie Rolls are great, but you got to add to brand portfolios in order to get the growth. Nothing's going on there. So you start to realize that this company is in its, I'm not going to say it's in its declining stage, but there's no longer anything happening there. It's just kind of not even a cash cow anymore. $500 million a year in sales, $500 million, $480 million. The owners, there's Class A and Class B shares, which you've got to be cognizant of, because B shares often have the voting rights. So those who control the voting rights control the company, right? And in this case, married couple Melvin and Ellen Gordon, Ellen's father founded the company, and she is now CEO of the company in her late 70s. Her husband, chairman of the board, is in his early 90s. So I owned this name probably 10 years ago, and I'm looking at, they were still earning great margins, paying a nice dividend, lots of cash, very nice balance sheet, good brand portfolio, old owners, aging owners, and the presumption is, they're going to sell out. He's 83 years old. How much longer is he going to want to be in this business? And every year, I'd get the annual report, and I'd open it up, and there'd be the picture of the Gordons, smiling, looking much younger than they actually were. So finally, after a while, you realize, wait a second, they're not going anywhere. And you look at the compensation, millions of dollars. Not saying they don't deserve it, but making millions of dollars in a company whose margins have been declining year after year after year. They're still profitable, but decline. And you finally reach the point where you've got owners who probably are not the best owners for the business. And at that point, I gave up years ago on the name, but I still follow it. And it's a shame, because it could be a great pickup for someone, for a bigger name who's willing to develop this brand that's been around forever. So not a net, but kind of a management tale of what to watch out for.